Any discussion of a country's debt necessarily should be paired to a discussion of just how well off a particular country is. Simply identifying someone as having an individual as having $100,000 worth of debt doesn't tell you whether they're rich or poor. Someone with $50 million of assets and $100,000 worth of debt doesn't have a problem, but someone with no assets and that same amount of debt definitely has an issue. So it's important for us to think about this scale of debt. And one of the most important things that we often like to reference it to is the capacity of a government or a state to be able to service its debt. Now, when we look at corporations, we often try to use debt metrics like a debt to equity ratio, but that can be really challenging for a state that doesn't necessarily play by the same rules or have the same kinds of capital structure advantages that a corporation might. Instead, the two major metrics that we use for assessing how indebted a country is to know whether a state is vulnerable or not to the kinds of problems that we saw emerging in Greece or in Southeast Asia over the last few decades. One of those common metrics is debt to GDP, trying to consider exactly how large the economy is that supports the tax base from which governments ultimately draw their revenues. So one of the challenges with debt to GDP, while it does seem obvious, is that debt is a stock ratio and GDP is a flow ratio. It's sort of like considering how much debt to income you have, even though strictly speaking, GDP is not a national level of income. It does, however, generate the taxes that a country can draw from. So strictly speaking, when we talk about a debt to GDP, we're usually looking at a scaled idea about a government's debt compared to a government's revenues. So while in the total size of government debts can be absolutely staggering in some cases, for instance, the US is looking at almost $30 trillion, very likely over $30 trillion by the time you view this video. It is also important to remember that they've got an absolutely titanic economy worth over $20 trillion at the same time. So simply stating that a particular state has a great deal of debt needs to be proportioned properly to its capacity to service that debt. Now, what you can see on the graph below on this slide is a measure of the US government's debt as a percentage of their GDP, which basically is a proxy for their capacity to finance that debt. It's not perfect because it doesn't include the interest rate, which is multiplied by the amount of debt they have to determine the ultimate cost of financing or maintaining that debt. But nonetheless, it does provide us with a relatively quick, easy basis for comparison. Now, looking at this data, you'll notice that the United States government has picked up a substantial amount more debt over the last 50 to 60 years. Rewinding the clock 60 years, we see US government debt in the range of about 30, maybe 40% of GDP in the late 1960s. However, looking at these numbers today in the early 2020s, we're looking at well over 100% government debt to GDP. In fact, more precise estimate might put us closer to 130% government debt to GDP. Now, on this graph, you'll notice when we see particular periods of government debt expanding. Throughout the 1980s and early 1990s in the United States, we have substantial government spending on increasing their military footprint, while not necessarily holding back on any of their other commitments, which of course led to an increase in government debt. During the Clinton administration, you had an effort to balance the budget and pay down some of the debt. But unfortunately for the United States, the political decisions made following the September 11th attacks led to a return of deficit financing, an increase in government debt, and then finally, of course, the 2008 financial crisis pushed them well up over 100% debt to GDP as the government was required to step in and guarantee a number of different kinds of organizations and supply direct injections of cash to ensure that the economy stayed healthy. Now, what's missing from the graph below is that you'll notice none of the data from the COVID-19 pandemic appears in here. So even though things had started to stabilize in the aftermath of the 2008 crisis around the mid-2010s, by 2020, things had gone absolutely berserk once again in a number of economies, and government debts continued to ratchet up. What we see here is that every decade or every generation, there's some kind of crises that we encounter, and governments have been quick to frequently to just throw money at the problem. Now, this is not necessarily the wrong approach, but there are consequences to this approach, which is that the government continues to build up more and more and more debt. Now, it's not obvious at what level we can take this debt to GDP before we start to run into problems. But some people have suggested that debt to GDP might, in fact, not even be the right way to think about this. Their recommendation, instead, is to focus more on national equity, looking at the total wealth that the nation has. When we talk about national equity, we're basically looking at the total value of all the assets in the country and subtracting out any of those net liabilities within the country. So, strictly speaking, if we were to consider it from this capacity, even though a country like Norway might have a national debt of 165 billion, which is a little less than half their GDP, it's important to note that they have about 8 times as much money in just the state pension plan of Norway. So strictly speaking, no one is ever really concerned about the Norwegians defaulting on their debt, regardless of the debt to GDP ratio they might have, because they're absolutely loaded, right? They've got roughly 300 to 400% of their GDP in their pension plan alone, which is an absolutely enormous amount of capital. So in that sense, we'd be looking at a situation where someone might make $100,000 a year and owe $100,000. That might seem precarious unless that person already has $5 million in the bank, in which case this is sort of a non-issue for them. So it's important for us not only to recognize the capacity of a government to service the interest obligations on its debt, but also to scale the overall amount of a government's obligations to the overall wealth of the society. Looking at numbers from last year, March 2022, in Canada, the total value of all domestic assets minus liabilities, or what would otherwise be called our national equity position, was worth about $15.6 trillion, while the combined debt of every level of government in the country added up to about $3.4 trillion. So as you can see, our overall government debt to GDP, or government debt to national equity, is pretty manageable. If we had to pay off all of the government's debt today in Canada, in theory, we could. Now, the government doesn't sitting on the money to do that. The government isn't going to liquidate its assets to do that. The government would literally have to draw on resources that it does not directly control, resources from the private sector. But the notion is that, taken collectively, our nation has the capacity to service our debts. And what we need to do is be mindful of our continuing capacity to do so. It's one thing for us to build up deficits over time. It's another thing for us to build up debt over time. But if the economy continues to expand, these are not necessarily problems for us. What is a problem for us is when our obligations begin to outpace our capacity to meet them. And that's where things start to get challenging for us. So always remember to take things like debt to GDP with a bit of a grain of salt. They don't consider the total level of wealth in the country. And they often give a wrong diagnosis when trying to understand the exact position that a state might find itself in. It can be very practical to consider national wealth in addition to a government debt to GDP estimate.